over time.
All right, we're listening in to Jerome Powell's testimony. Let's listen in here. They lowered the federal funds rate by 25 basis points at 11.
Economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter.
We're seeing great loan volume in the fourth quarter.
In our summary of economic projections,
when they lowered the rates, 10-year Treasury rallied, I think, around October, and we saw a lot of volume. We closed a 7-Eleven deal. We're doing a Valvoline transaction. So there's a lot of liquidity right now in the market. I think the economy is doing a little better. 10-year Treasury right now, 4.16 on this news.
Available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market,
although consumer sentiment has been going up as of late, so it's more of a hawkish situation.
The projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2%.
Manufacturing was also doing really good.
Very little
inflation have been released good news on the
October. Total PCE
on the manufacturing front.
Ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast,
Bank of Japan has been
for services.
Raising rates
Near-term measures of inflation
as of late,
have declined from their
strengthening the yen, which could put upward pressure on the 10-year Treasury yield.
Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside.
So he's saying he's a little more hawkish there.
There is no risk-free.
The target rate was 3.75 to 4. It was at 3.89 with a 25 basis point decrease. That would put us in at 3.64.
Relatively short-lived.
They said that they were going to start to buy the short-term treasuries to support liquidity, which is always good. So we should see good ample liquidity going into the first quarter here.
But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4.
I think Trump's happy right now. He got what he wanted, the lower rates.
Further normalization of
so it's kind of interesting. Jerome Powell saying they're going to be cautious going forward. There's got to be a little bit of pressure from Trump in their decision, although
bring it within
7 officials said no change at all, which is interesting.
Well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant.
If you're on the live here and you want to comment, I'd love to see your comments. Comment.
At the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued
one good thing, crude's been marching down at 60, Brent crude 61.91.
Indicators of reserve market
so
conditions,
Trump's
the committee judged
strategy with Venezuela seems to be working. The price of oil is coming down.
At today's meeting,
that's a big stimulator for the holidays. People can go on vacation. When they go shopping, they're spending less for gas.
Supply of reserves.
That's really a relief to
in
consumers.
Holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline. So
40 billion, they're going to buy 40 billion in short-term bonds, which is good to
in our implementation framework and
to support
means that the federal funds rate and other
short the banking system liquidity
by the setting of our administered rates rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be
see where the stock market is here.
Economically sensible.
Get on and see where the stock market
is. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment. Bringing
looks like the Dow's happy about it, up 391. So Dow's doing good. Wall Street's cheering the announcement, I guess.
Matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
See what rates are doing.
We do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
We'll listen in on the questions. 10-year note, 417, it blipped up 1 basis point.
Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September, and 175 basis points since last September.
If you're getting short-term financing, you're going to debt coverage much better. For those who have construction loans and need a takeout, you should be able to get more loan proceeds now because you've got lower short-term rates, and you're going to debt coverage much better.
Steady unemployment rate. This seems like a pretty
call us for any takeout, refi, cash out financing.
Early bet on a
Rates are still really attractive, 5 and 5/8.
Productivity out there, what's driving?
5 and 5/8
So a
to
number of
like
things are driving, what's happening in the
625
marketplace. And I
for
would say if
investment
you
grade
look at
credit,
our
like
outside forecasts,
Starbucks,
you do see
7-Eleven with gas,
many
Dollar
industries.
General.
So it
We'll do a
is
25 to 30 year
remarkable that
AM.
consumer spending has held up.
Interest only for
And
slightly lower
to
leverage
another degree,
deals.
it is
You
that
can always call me over the
AI
holidays,
spending on data
760-803.
and related to AI has been
6464.
holding up business investment.
If I'm not
So
around,
overall,
jump on the website, talk to Tony, our AI
baseline
agent,
expectation for next year is
assistant
at
for
least
current
that
pricing
Fed,
underwriting,
without forecast for growth, a pickup in
www.marabellafinance.com.
growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
So they're saying fiscal policy, Trump's going to be supportive. So that's interesting. I guess maybe his tax decrease is what he's talking about. If Trump does a slight tax decrease or gives a tax credit, that's going to be bullish to the economy.
Is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor in.
I personally think the fourth quarter was a little stronger, at least for us. It was.
We held our policy.
We had a flurry of transactions
for more than a year.
So I would say it's a little stronger than I anticipated. So maybe there's some cross currents with the government shutdown, but commercial real estate brokerage transactions seem to really pick up in the fourth quarter.
The labor market began to show real signs of weakness, and so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. So
anyway, I want to thank you for watching Net Lease TV this live.
Work our way through.
I'm happy the economy's doing good. Have a happy holiday season. You can always call me or text me for Net Lease financing. Quick back of the napkin quote, 760-803-6464. Happy holidays. And thanks for watching Net Lease TV live. Woo!
You have a whole lot of